Hi, what's up everyone, and welcome back to another video here on our YouTube channel. Hope all of you have had an amazing week, and I thought for this weekend I was going to cover the topic of using limits to enter your positions when you're trading supply and demand. This is because I've been getting quite a few questions about this throughout this week on Instagram, where you can also contact me if you have any questions. But I thought we were going to take a look at that. We also had a very nice example on gold that just happened yesterday on Friday, which some of you might have managed to capture. I also managed to enter it. Very, very nice, powerful zone that we had. But yeah, I have a picture of the actual trade right here. It looks a little bit fun. I did actually miss one of the limits. But today we're going to cover exactly how to place sniper limits like these, and also some general guidance or guidelines that you should follow when you're trading using limits, because there are some risks associated with that as well. So we're going to jump straight into it. So see you all soon. Alright, so first of all, what really is a limit? When you're trading using limits, you have two of them. You have either a buy limit or a sell limit. And what these generally are used for is when you're trading reversals, so when price changes direction. So in the case of a buy limit, what we have is that we have price say going down or something, and what a buy limit is that you place your order below price, and then if price comes down at your level and then triggers it, your buy order will be activated. And hopefully what you're looking for is for price to then go up, since you have now bought at this price. And the sell limit is the exact opposite. You place your order above price, and then if price comes up here and triggers it, you're now into a sell position, and it could obviously also continue up to there. But that's basically what a limit is. And you also have buy stops and sell stops, but I don't traditionally use those, especially when trading supply and demand. I haven't used them in essentially forever, and yeah, they're just not really applicable to the style that I trade, but yeah, they exist as well. Here we can see a very similar diagram to one in a video that I posted about order block theory not too long ago. We have our price moving here, producing an area of indecision here, which is what we're looking for when trading supply and demand, followed by the strong push to the upside, giving us this nice fresh order block right here. And the main idea behind these sniper limits is that you only want to use completely fresh zones, so price coming down here for a second touch here, not a third or a fourth one or anything like that. That's just my recommendation, because any touch above 2, you're much more likely to get fake outs, similar to the one that I talked about in the video just last week. So you really want to use these fresh zones, these second touches, where you have the most liquidity going on and the highest number of orders sitting down here at the order block. So what you essentially want to do is just place your limits kind of scattered a little bit throughout the order block. You don't want to place them at one particular region, because then there's a chance that price first of all misses it, or if you place a huge order at the top, you're gonna have a much stronger drawdown than if you split them up. And you obviously want to split your risk across these, so you can have 3 like this. And then obviously the best case scenario that we're looking for is for price to come down in here, activate all our orders, and then continue to the top. So that's a theoretical best case scenario, and that is sort of the way you want to be applying this. Once again, only to super fresh zones, second touches, only situations like that, not third touches or anything of that kind, only fresh, and that's what you want to go for. So now we're going to go back and take a look at the gold example that we had, well, that occurred just yesterday, so just Friday of last week. So we're going to jump straight into that. Alright, so here we can see gold exactly the way it looked from the 1 hour time frame perspective on the morning of Thursday, which was the 27th of May 2021. So what do we look for when we're trading supply and demand? The first step is to generally look for the actual trend itself, if it is now actually relevant, which in this case it highly is. Looking at gold here on the 4 hour, we have a very strong bullish trend. So in this case, we only really want to look for buy opportunities, since it is showing such a bullish scenario, and price is not really trending in a ranging market, so to speak. So yeah, what do we look for? We look for these moments of indecision followed by a very strong push, in this case to the upside. And here we have just that, a very nice indecision candle just here. So if we just mark that up with a fresh zone right here, and then go down on the lower time frame, like the 1 hour for example, and just gonna adjust this a little bit to cover these wicks a little bit more perfectly. Alright, so there we go. Okay, so now what we're waiting for is for price to obviously come down into this zone to then enter a buy or a long position if we see the correct form of evidence, and then ride it up to the top to continue this bullish push that was established earlier. But in this case, I did end up using buy limits, and the only case where I actually recommend to use them is if you're not actually able to observe the charts when you think the actual trade setup is going to happen, which was the exact case for me. And the reason I recommend that is because waiting for proper confirmation is only advantageous to yourself, and it's only going to increase the win ratio of your trades. So that is recommended from my part. But if you do not have to use limits, only these super powerful fresh zones at second touches, no third or fourth or anything like that. Just simply like this. And then what I ended up doing to place these limits was I just placed them on round numbers. I'm gonna have a picture here in the corner anyway, so you can compare them, but I think it was 83 and 82, and my second order at 82 didn't actually end up getting activated, which we will see quite soon. But yeah, you want to place these at round numbers, at least conventionally for me, because 83.1 and 83 is more or less the same, and just putting them at round numbers just ensures that you do now spread them out evenly throughout the block. You don't want to have too many up here or too many down here. It's better to spread them evenly, obviously even risk. In my case, one lot size each. Always want to keep your risk consistent, so if you do not twin trade, you want to split your risk. But yeah, just gonna see how this develops. No, it's gonna go down and activate them. It was actually a pretty quick push down, I think, which even if you were, yeah, okay, so here we go. A 1 hour candle went down, activated the first one. Looks like the second one activated, but in the real case it didn't, unfortunately. Only got one of them activated. But currently still riding this to the top, looking to exit somewhere up here, or maybe earlier depending on how price develops. But yeah, just place your orders very carefully here at these fresh zones at second touches, and that's it really. That's how simple it is to get sniper limits. Just gotta make sure that you plan your setup carefully, and yeah, as said, only focus on these really high probability opportunities. And that's that really. Just gonna quickly go over some pros and cons, and yeah, then that's the video itself. So yeah. Alright, just to quickly wrap up, trading supply and demand using these buy and sell limits. Advantages are obviously number one, that you do not have to observe the chart itself, which can be very beneficial if you don't actually have time in the instance. For example, if you have work to do or university exams, anything like that. If you're not actually able to observe the charts, I highly recommend using limits if you have practiced enough with them. And then secondly, you can't miss in the sense if price does now go down to your zone and actually reverses as you predicted, there's no way that that limit does not get triggered, as opposed to if you're now sitting at the computer and waiting for market execution. It is possible to miss it, but there's no way that your limit will not get filled. But disadvantages at the same time, there is no way that you can get a proper confirmation on your trade, or more specifically actually observe a break of structure at the zone, which means that you're quite prone to fake outs and easily getting stopped out in that sense. And also you can't load up your position, which sometimes I do. For example, when price actually starts moving in your favor, you can add some more positions carefully if you have not practiced with that, because then without increasing your risk too much, you're actually increasing your potential a lot. And then last of all, it is only applicable to super strong zones, because yeah, you're not able to observe for a confirmation, which means a fake out is likely. So super strong zones makes fake outs less likely. But that's really that's how simple it is to use limits together with supply and demand. And yeah, I hope all of you will have a nice continued weekend and are preparing nicely for the trading week ahead. Best of luck, everyone.